The summer is just rolling right along, isn't it? Before we get officially begin, the NFA Compliance Rule 2-29C subparagraph 1 disclaimer will satisfy the regulators that we've passed that information along to you and to inform you that trading is a risky business. So trade with monies you can afford to depart with. Very good. We'll satisfy the regulators. All right, let's take a quick look here at where we've been and potentially where we're going. So in the PTG community, I've basically described the markets as kind of like a Ferris wheel where the markets are just rotating back and forth between sectors of the economy, sectors of the markets, technology, financials, discretionaries, healthcare, et cetera, and all the various industry groups, all right, that are domiciled within those sectors. So though we trade our, indexes, whether it's the NQ or ES, primarily I think everybody here is focused more on the ES than NQ, but works the same. And essentially, the markets just rotate. Yesterday we had, markets could not get through the 95 area, and then buyers get trapped, and then it rotates lower. Sellers get trapped, and then it rotates higher. So you get this kind of rotational aspect. So recently, since the last week where we had the two strong back-to-back up days, the market's just gone into this rotational balancing phase, which is normal. You would anticipate after very large significant moves that we've seen that the market needs to work off some of the excess. It needs to, rebalance itself. So we love trending conditions, don't we? We love those big directional moves. And there's lots of potential within those. But also look at them as imbalance areas, right? Imbalance. So although they're great, once you catch, onto one of those, the majority of the time though, the market is more rotational. And so it has to find its natural levels that buyers will step in after a big move. I mean, the buyers push the move up, but then the sellers come in. There's obviously profit taking, etc. And then the market has to find a level where it wants to continue to hold, right, as support. So we see that level here clearly now into the 25s, 30 zone. All right, so there's your key support. All right, so any future attempt to push down into that level, we would be expecting or anticipating, right, a buy response down at these levels, right? So yesterday we saw this rotational move down. Some people call it a liquidation break. That's fine, whatever you want to call it. Yesterday 775s was our line in the sand, and when that gave way, we got our rotation all the way down. Yesterday was a cycle day 3. Okay, today we start a new cycle, and into today, technically we had a decline, but really was negligible versus the close, which is at 53s. So that held pretty well. Our line in the sand today is 60s, right? Remember, it's always plus or minus 5, the way I outline it. And of course, CPI release here, all right, had a nice positive response and so forth. Upside targets here for us, 75s through the 95s. Okay, and again, we're fulfilling that particular zone early, And so so the challenge is going to be back up here into these 95s where it's held pretty well for resistance, right? So we'll write that out here. So there's our framework, right? I refer to this as a sandbox, just kind of a colorful term. The idea is that's where the market is doing most of its business, trading back and forth, occasionally getting sand kicked in each other's faces, right? But for the most part, that's where we've been. Summer rhythms, yes, for sure. Historically, August is the slowest, uh, less volatile month in terms of seasonality. And although we've had some moves, we've had some tradable days, no doubt. But now we're really entering into the period here over the next few weeks. It's going to be heavy vacation periods. Of course, uh, schools are reopening, all that good stuff. That doesn't change anything for us. It's just being aware of the backdrop. Of course, anything and everything will happen. So we just need to constantly be prepared, plan, execute, right? Prepare, plan, execute. That's it. Nothing changes for us, no matter what the market is giving us. Our same premise has always been since day one and forever and a day. And that's a long time. Staying in alignment with the primary direction underlying the time period that we are trading in. And of course, that time period for us, right, is the intraday period. So yesterday we were aligned on the sell side. Today, as it appears at the moment, anyways, we are aligned where? On the buy side. So again, that kind of rotational rhythm, Ferris wheel, maybe even want to refer to it as a merry-go-round, but you get the idea. All right. All right. We're going to start here in just a short bit. Let me know if anybody has any questions. Pre-market usually a good time to hit on any questions that you may have, if you have them. If not, that's great. Again, just a note, folks. Right, I did post it up in the room. Pitbull Traders is having a huge promo for the remainder of August. 40% off all evaluations throughout today, beginning today through August 31st. That is all evaluations. So if you have not taken advantage of the evaluations that Pitbull offers, please consider doing so. All right. Remember, the pit room here is free of charge. So all the contributors are, again, spending their time to help you become better at your craft, different styles, different analysis. So hopefully everybody's getting something out of this. That's our intent, is to provide some educational read through. And again, the way you folks can say to us, we love what you're doing. I'm going to buy an evaluation. And again, 40% off, you can't, I don't know, you can't beat it, right? So give it a shot. Even if you're trading your own funds, even if you're self-capitalized, we're gonna be doing a some webinars upcoming, and we're going to be discussing the benefits and so forth of using props, even if you are self-funded. What is the 3-day cycle today? CPZ, let me just put that up on the screen for you. Okay, right now it is 77.68. And just in terms of the 3-day um, central pivot zone, you can see here again when the market rallied strongly. Okay, here's your 3-day central pivot zone, right? As it's remember these things do trail initially, and you can see how wide this zone is. Okay, so a quick note about the 3-day central pivot zone. So the wider the zone, that means obviously the wider the range that it's measuring. So on a 3-day basis, that also means what? When you have widening range, increasing volatility. Okay, so you have a wide range there. So that tends to trail. And then and you can see here it started, we started narrowing. Look at how narrow now these have become. All still positive, meaning that they're still stair-stepping higher. But what does this mean? Now we have a contraction of volatility. Or a way to another think about it is we're entering into that range, or have entered already into that range kind of rhythm. So volatility contracts, the ranges contract, the 3-day range contracts. All right. So again, these zones are not predictive. Let me just make that perfectly clear, right? They're not predictive, but they're coincident. They tell you, what the 3-day central average is, and that can be helpful in your trading. Well, there has been volatility in August in terms of widening of ranges. That it has. All right, but in terms of the markets obviously go through a period of expansion and contraction, right? So again, on this way up last week, that was your expansion stage, right? And now we're going into this, right, rotational range that we have now. So there's your contraction range. So the question becomes, and this is what everybody obviously tries to, kind of predict, is will the and again, I don't like asking questions with the starting with the term with the word will, but I'll do that. Will the market rally and expand further after this consolidation period, right? Or will it, you know, find some reason to break lower? I don't know. We'll all find out together when it happens, right? One thing that is kind of a footprint of a potential, right? So you can see here how the range pretty much has been kind of oscillating for the most part within the boundaries. What we'd like to see is a shortening of one of the pullbacks. So if it's going to eventually break out, we'd like to see a shorter swing, more shallower swing. So that would be an idea to look for, a clue perhaps. Is it going to be today? Anything can happen. All what we want to do is stay aligned, and that current alignment as we begin today in about 3 seconds is to the long side, and we'll be flexible to adjust accordingly. All right, let's make it a great day. If you have any questions, put them out there. All right, we'll look for our first 5-minute opening range as some insight as to potential. And then the prior high up here is 96s. So we'll see if we get a move above 96. Today's the cycle day one. Goal of the cycle day one is to establish a new cycle low from which to rally over the next several days. And away we go, ladies and gentlemen. For those looking for early longs on a dip, right, the A10 over here, top left or middle top left, is near to the 75s. So see if that offers us any opportunity there early. All right, back at the top end of the range. Now, you again, in terms of leans, all right, all what we're saying is that the market has been pushing higher, so we're respecting the fact that the lean up until this point is higher, right? It doesn't imply that it's going to remain that way. By no way does it imply that. And we are at the top part of the range, so there's naturally an expectation of a pullback, right? So some of you may want to be fading, against that 95 target that we have, which is perfectly fine, right? If that's part of your trade plan, right? All right, let's see if this A10 plays out for us here coming into view. I will say that the A10 for us has been a little bit of a, I don't know, wonky this month. So we'll just take it one step at a time. Small bets. All right, let's see where the market wants to respond. Uh, if the CPI number is adequate enough, perhaps maybe they want to use this as a buying opportunity. I'm sure there are some outstanding shorts from yesterday that maybe need to cover. We'll see. All right, again, we're long of 810. Let's see if we can get some of these targets up here on a bounce. We have a fairly wide opening range. There we go. Opening range now is intact. 71, 75 up to the 94, so 20 some odd handle range. So that should provide us some good movement. And again, down went Frazier. Yeah. All right, here we go. Let's see if we can get this push up. Come on. Cheering it on doesn't change anything. Do you ever find yourself cheering on the market, cheering it on when you're out of position, quietly in your own office? Market doesn't hear you. I've tried. You got a lot of better movement, perhaps, like you say, like overnight and pre-opening. Then you get the morning grind. All right, we got a kind of a some opposing activity here. We got premium and A4 on the short side. We got a long here on the A10. So they're diametrically opposed. One will win. One side will win. Maybe both will win, but it's not a hedge. Oh, and by the way, again, if you are trading these prop accounts, you really need to be aware of the hedging rule. Okay, where you have one long, one short. So you need to be aware of that. That will cause a violation. So just be aware of that. Opening range ES. Yeah. Just there we go. Opening range ES. Let me just move that over a little bit. Yeah, I can't take yesterday's trades off like that. Then today's trades won't show. All right, A4 on the short. Again, playing out so far. Target one filled. That's on the middle bottom. All right, just near the target two. We got a premium on the top. Again, that's a short. All right, two take profits on the A4. We're okay. Profit one on the premium. So the short side is winning. It looks like we're going to get stopped on the. Yes, we did. We're going to get stopped on the A10. That's been the bugaboo this month. A4 has been doing pretty well. Our premium and discounts have been pretty admirable as well, I must say. Again, as I mentioned earlier, the A10's kind of still. I think they went on vacation. I think the A10 went on vacation for August. That's why we have different strategies, right? Different premises for each strategy. All right, so we're break even on the balance of the short positions. So if we get a bounce back, take what we can get, right? in kind of a lately. Just take what we can get. It's always nice to be holding for a big runner, but again, sometimes you just want to take what you can get. Anybody scoot along on those shorts? Again, this is our auto trade assistant that's executing these. The ATA is automated. Sometimes the automation can certainly help you. Um, if you're having trouble, with the decision process. All right, again, if you're following our signals, that is. All right, we're going to get stopped even on the premium. It looks like. Oh, maybe not. Oh, good question, Oris. So Oris asks, how is the shading of the background for the A4A10 charts determined? That's a great question. It's interesting because I changed those last night, and I was wondering if I would get a question on them. And Oris, being as inquisitive as he is, which is terrific, asked that question. I was looking for somebody to ask. I will address that shortly. Okay, I will address that shortly, Oris. Great question. All right, shorts are still alive. I thought we would get punched out there on the premium. We came within a tick of getting stopped even, but Mr. Market has been good to us so far this morning. So thank you, sir. Is it a sir? Thank you, Mr. Market. Or yeah, it's a Mr. Market. There's no gender stuff in this community. It's a Mister. Mister Mister. All right, nearing to our target on second target on premium. And again, on the A4 over here, we're just simply, we got three targets out, take profit three, 1, 2, 3. And now we're just holding it a runner. So if we can get kind of a nice runner out of this, which is always what we're looking for, our job is done in terms of taking the initial trade and then scaling out. There we go. All right. Premium 2 got filled. So that completes the premium short. And again, all what we're doing here is holding this runner. We'll move the stop down a touch just to manage that right up against the A4. All right. So now on the runner, the way I look at the runner is that should never hurt you. Should never let a runner go into a negative. It can only add to the trade. The core trade that we're looking for, right, is these three scale outs. Those are the highest frequency levels. And the fourth contract here is just really simply if we get a nice big runner and it can only add to our P&L, but it should never hurt you. Never let a runner get into a losing position. Scratch is fine. But never a loser. Marcus, are you in the room? Has Marcus joined up with us today? I don't see Marcus yet. All right, there you go. All right, so trades are complete at this stage, right? So we got our trail out, which was still in the profitable position, but there it is. So two nice trades again versus the A10, which did not play out again. So anybody who has questions or anything about that? Okay. Let's see how the next 10 minutes or so goes, Orist. Right. I want to try to keep everybody focused here first before we address your question. Yep. Trades come first. Yep. Might be entering in a little bit more of a rotational range here.
First pullback.
So interesting, the 95s, which you saw yesterday, which was repelling the buyers, right? Went right back up to that level. That's not coincidence. That's design. All right, keep in mind, the line in the sand today is, everyone, 66.50. Wait a minute. Did I say 66.50? Oh, I meant 77.60. All right, 77.60. So that's our line in the sand. Again, low right now is 68. So if we get a cut through there, let's take a look here. Closing VWAP yesterday was right here around 65s. So I could have easily used 65s, but again, I selected 60s, and that's 60s plus or minus. All right, so plus or minus 5. So if we get a break below that 60, 65 area and a hold below it, we could easily, fill that gap. Remember, this is an inside gap, by the way. All right, so inside gaps tend to get filled. All right, so we're perhaps looking for now next a rotational move down, right, to fill that gap. So keep that in mind. That's obviously a scenario. What would squelch that scenario if buyers regained control back above recent highs up here, right? So what I like to do is lay out scenarios, dynamic scenarios as the day unfolds, looking for how far the buyers were able to push it and then not make any progress, and vice versa for the sell side. Not trying to predict what side is going to win, what directional move is going to unfold, but rather just outline it and say, well, if the buyers, are able to now move it back above these recent highs and then hold above them, then advantage will go to the bulls, right? To be able, because they're demonstrating. It's all about demonstration, demonstrating that they can do what they're intending to do, and the opposing side, i.e., sellers, are not resisting them any longer. And again, that would be the same for the downside, right? The sellers, and the sellers could be long sellers, just saying basically, all right, I'm just gonna GTFO and kind of refresh and take a new look. And of course, you have the more aggressive side, the short sellers, right? Really looking to apply that pressure to try to get another liquidation break. But in both cases, it's going to be the same. You know, I try not to impose what I think is going to happen. Rather, I just rather outline the scenarios of what the potentialities are. So the potentialities right now is for a potential gap fill. It's only a potential. How would that and where would that change? Well, if the buyers, again, demonstrated that they want to move it higher. So you never need to have to pick sides. Some people like to pick sides, right? Some people like, I'm a perma bull, I'm a perma bear. Some people like to pick sides. I just like to stay with whoever is the dominant side for however long they're going to be dominant, right? So, and again, that gap fill is a question mark. '78. Ah, very, very nice, John. Very nice. Super. We have anything at 10 o'clock? No, right? Because the CPI came out. There's really nothing left here at 10, is there? Let's take a quick look. Nope. Crude oil inventory is next on deck, and then 10-year auction at 1 o'clock. So just CPI. All right, 10 o'clock. Usually you get some sort of a program volley. If you may know, programs tend to happen at or around the 30-minute mark of each hour. Sometimes they kind of like this, be sneaky and do it a few minutes early, a few minutes after, minute and a half before, minute and a half after. They tend to be sneaky, but generally you get time-related programs. All right, everybody's familiar with VWAP, right? Volume weighted average price. Well, there's something called TWAP. Anybody ever heard of TWAP? TWAP is just time weighted average price. It's not universal that everybody can use it because it's kind of an individual uh, metric. So if you're an institutional account and you have programs internally to buy and sell, you may set it for intervals throughout the day, or the combination can be a time interval with a certain uh, level of volume that has taken place between time intervals. I know it can get a little complicated, but it's really an individual metric that institutions use for their own trading. So you have humans running the programs, but the programs are doing everything. You don't have a buy side trader that's actually making every decision any longer. Used to years ago, but not today. Today it's all programmed. But speaking of kind of these programs in general, there is a relatively consistent pattern that top of the hour, bottom of the hour, sometimes around the quarter past the quarter or to the hour. Again, you get these intervals, and not everybody's doing it at the same time. Sometimes people do 20-minute intervals or 17 and a half. Like, why 17 and a half? Well, again, it's based upon their own research. Maybe they don't want to be clustered with everybody else at a certain time period, right? So, but generally for us, since it's a bit more generic, we're just saying, all right, there's typically going to be some sort of a program near to the bottom of the hour, to the top of the hour. Watch the 15-minute time period. Every 15 minutes, you'll see something kind of clicks off. Doesn't mean it's the same institutional player either. And it happens on both sides, buys and sells. So it's just kind of like a little flurry of volume that takes place. Yeah, we're on Deca time zone two. Again, right now, the kind of, ask yourself, what's the current lean, right? The current lean favors what? Sellers, right? We have an 89 EMA, right? Again, it just kind of, it's a drift, right? It's a drift. So when we're looking at this, okay, I just want to basically stay aligned. Even if you don't have a trade on, you want to say to yourself, I want to stay aligned with, you know, the dominant side. Well, right now, the dominant side, as we look at it, is the sell side. Okay, that's all you need to know. And then what you want to do is you're looking for moves back up, near to that 89 EMA, and then say, okay, well, I got the dominant side. I got an EMA that can help us, the 89, which is our proxy, and I have an A4 there, which is the yellow line. Okay, I'm going to probe a short until they can prove that the market wants to reverse higher. That's kind of the thought process. It's not really complicated. All you're saying is, I want to stay in alignment. I'm not trying to position myself or actually more. of- I'm not trying to predict that there's going to be a break below those 65s. I know if there's a break below 65s, we'll probably a fast move to 60s, and again maybe something deeper to close the gap. But I'm not predicting that. Don't want to predict. Don't have to predict. So train yourself to be thinking. This is what I'm trying to accomplish now in our group community with everybody is we have the tools, we have the technology, we have all that good stuff, right? Most everybody knows how to use it in terms of the mechanical aspect of it. But I think they're still generally lacking, and not for anybody's, individual, uh, issues, but it's kind of, and unless you're 100% mechanical, which is perfectly fine, most of us are making some sort of a decision, right? Of reading the market and trying to outline, like trying to handicap what should I be doing. Well, all that comes down to a thought process, a decision matrix. So, and that's kind of where my efforts are with our community. All right, hopefully I don't miss a trade here. I'm gonna answer Orst's question regarding the zones. So I made a couple adjustments here. Nothing significant. It's just more a representation of something. So let me use this chart here. Let me just expand it out a little bit. Okay. So everybody's listening. We're all good. So again, this is based upon the ATR analysis that I've been doing over many many months. Okay, and it's simply, you've all heard of the terms maximum adverse excursion, maximum favorable excursion. Okay, hopefully you have. So again, I conduct an ongoing study. Yeah, I conduct an ongoing study whereby I'm constantly tracking what the maximum adverse and favorable excursions are. And then what I've done here is I've based one of my analyses on the A4. Okay, so the A4 is, A4 bear, all right, A4 bull. Okay, so I'm just referencing the A4 line. All right, so that's the metrics, that's the starting point, the baseline. Okay, I'm also measuring when price tags the A4 for the very first time. No double tags, right? Just the first time. So bottom line is I'm looking for what is maximum favorable. So if we were to take a trade right at the ATR, the first time it touches it, what is the maximum favorable move to the down? Let's just take a short for instance here, right? So if we entered right at the ATR, what's the maximum favorable? Okay, and what is the maximum adverse? Make sense? Okay, so that's the baseline. I'm really interested in the beginning here what the maximum adverse is, because I don't know what the favorables, will be, and nor do I know what the adverses will be in the very beginning. So when we do this research, it kind of generates that information. All right, and all it is metrics. That it doesn't mean that a, those are the trade values and so forth. It's not actual or trade, just simply metrics, just a simple measurement. But what I'm trying to measure is what can I control? What is the primary, thing that I can control? Well, I can control trade selection, so I already have that as the input. Enter at the first touch of the ATR. So one contract doesn't even matter. It's just, remember, we're just, and then how far has price gone against? And so what I can control is where I put my stop. How much am I going to risk? So everybody should be very much familiar with that. I don't think anybody here that is not, but that's the idea. So the question that becomes, where would I be putting my stop? Well, I want to put my stop in an area where there's less frequency of prices being touched. Less frequency. Does that make sense? I think it should. Right? I want to be at least in an area percentage wise where out of all the trades that I'm tracking, I want to have the lowest incidence, not no incidence. I mean, you can have that, but that's not really practical in most cases. So I want to have the least incidence of occurrences. So what I've done here is let me just show it to you. Right? This is based upon the A4 And these are my maximum adverse excursion metrics and the favorable excursion. So let's just focus on the adverse, okay? So what I've done is, and it creates as you can clearly see, it creates kind of like a cluster, distribution profile. All right. So you'll see that the highest incidences, right, range between, roughly 2 and 5 points. In other words, once I've entered the trade, or we've entered the trade at the ATR, the move adversely, okay, has a high incidence or high occurrences between 2 and 5 points. Does everybody follow that? And then 6 and above, okay, there are incidences. Now, this I believe is 200. I think it's like 300 samples right now on this particular one, 300 samples. So out of 300 samples, it just kind of shows us the percentage of incidences or occurrences. So what I want to try to do is, if I'm going to take a trade, I want to have my stop somewhere now above actually 5 to 6. Right? Why? Because 5 to 6 here out of 300 samples are roughly just under 10%. All right. Then above that, it's 7%. And then, of course, it drops to 2 and so forth. Right. So above 8, 7 to 8, 2% of the trades, 2% of the time, the adverse move after an entry at A4 only occurred 2% of the time. So you may be looking at this and saying, okay, between 7 and 8 could be a good spot to enter my trade. Oh, excuse me, to put my stop. And again, this would be for planning purposes. Okay, so like maximum stop, where would that be? Well, out of 300 trades that I'm tracking so far, samples, only 2% of the time, right? So you got 98% of the time, I'm not going to get stopped out, or at least historically. Does that make sense to everybody? So that's kind of a metric that I've been tracking. But maybe maybe 8 points is a little bit too rich for my pocketbook. I want to try to get something, a little bit more, a little tighter, but I'm willing to give a little bit up in terms of the incidences, right? So definitely between, roughly under 6 down through the lower levels. That is where the majority of adverse excursions occur. So I don't want to do anything really in that area where I'm placing my stop. Some people say, "Oh, I'm going to put a 3 point stop." That's terrific. You want to? Well, 3 point stop, okay, gets hit 21% of the time, right? A 4 to 5 is 20% of the time. So you're talking about 42%, 41, 42% of the time, you're gonna get stopped out before hitting a target. Okay, so if that's something you want to do, that's great. So basically, I'm just using it as a kind of a guide as to potentially where I can put my stop maximum. I just want to know what that read is. Okay, so what I've done here is I've placed this zone. Okay, and I'll show you how to configure it later. But I just want to talk about it. The configuration is not as important as the concept of it. So basically, what I'm doing here is I want to highlight the maximum area, maximum edge based upon my maximum adverse excursion. Everybody following that? All right. So if my entry is right at the ATR, then this level up here is what I'm using as a maximum adverse for a stop. Okay. So what I do is I look at this and saying, well, each time it comes into these ATRs, I have basically this room to work with. Okay. Now it is based upon entering at the ATR. Again, I have to have a baseline, but that doesn't mean your entry or my entry is going to be always at that ATR line. Partial entry could be if you look into say, I'm going to scale in. But what you want to do is use this. It's basically a risk metric, right? This is where your maximum risk, right, would be, right, per contract now. Max risk, all right? Now, of course, there's going to see many times where, it doesn't even come close. But the idea is this, right? So again, on first touch, you could, this would be entry one if you want, right? Where would your stop be on entry one? Maximum risk. Say one contract. Let's say the price kind of moves up into the zone here, but the ATR has not shifted yet. Remember, if it shifts, it's an automatic stop out. But if it does not shift and then pivots lower, right, I may put entry two over here. So I sold one a little bit lower at the ATR, sold one higher than the ATR. I'm still within that zone. Call it the safety zone, whatever you want to call it, the safe zone. All right. Where does my stop go? On trade number two, contract number two, above this high. Okay. So I actually have a smaller stop value on trade two than I do on trade one, right? Say on trade one, I have the maximum stop, right? Stop loss here above that edge. If I take trade two, my stop loss is still above that edge because statistically, right? I'm not, putting it further above. I'm just statistically, I'm based upon my research, that should be a fairly safe zone majority of the time. Follow? Right? So into the 90 percentile, it's going to be safe. But I don't know about this particular trade, but it's generally going to be safe. So what I'm basically using is I'm using it as a risk, a maximum risk metric. So because a lot of times you'll see like prices will come up into the zone here, right? And then, in this case, it did flip. All right. So let's take this example right at the edge here. Well, it's just about to flip. Right there it goes. It just flipped. But the idea would be like, you come up into the zone, right? So you can take any trade, and enter any trades anywhere within the zone, but your max risk is going to be at that, in this case, the upper zone edge for a short, and it would be here. This would be even very good examples right here on the long this morning. So you can see a natural uptrend. So we got a dip into the zone. Okay, so you could buy one here, right? If you wanted to lay an order right at the zone, limit order. In this case, it dipped a little bit below, so you could have bought one here as well. And why are you buying them there? Because the zone hasn't shifted, and the maximum risk, right, is based upon the lower edge of that zone. So I can enter trades all within this area here. And so my stop on the first is going to be here. My stop on the second is also going to be here. So in other words, I can blend into, that it's valid to enter anywhere within the zone. Again, the way I'm looking at it is I want to enter at the ATR or below in the case of a long. ATR above in the case of a short. But I want to use the ATR. There'll be some times where I'll miss the ATR. It pulls back like here, didn't touch the ATR. Okay, that's fine. If I decide to buy them here, in a case on the left, far left, right? Well, is my max stop all the way down to here? It may not necessarily be, right? So remember, this is only on a specific type of trade where I'm buying them, I'm entering at the ATR or slightly lower. the question is, where's my stop loss go? That's what this answers. Somewhat of a long-winded explanation, but I think you get the idea. And say, take a look at this move here, right? Notice what happened. It even exceeded this zone for a moment, okay, on that whipsaw. But notice the zone never broke. It never shifted. And then the market starts moving back up. What do you do here? What would you do? That's a buy, right? Again, if you're playing that, that was the CPI announcement, but again, just kind of outlining the potential for what you could be doing, right? And so, again, just because it exceeded that risk zone, of course, that was the CPI print. I wouldn't have been buying them there because of the print. But once once I'm looking at that and I'm seeing it's exceeded it and now it's reclaiming back in the zone, okay, then you could buy. And what basically is that, everyone? That's the right side pivot rule. There you go. Now you're getting it, right? So what this offers us is a view of where my maximum risk would be on a trade. I think many traders out there, they take a trade, they don't really know where their maximum risk really needs to be. That's what I can control. I can control the type of trade I take. What's my maximum risk I'm willing to lose per contract? It works on minis, works on micros, right? There's no difference. But I want to know, where can I put my stop where statistically it's a low occurrence, low, not no, a low occurrence of stop outs. Well, how do you know that? Well, you have to measure that. If you don't measure it, how many? I can't. I can only estimate, perhaps, out of all the population of traders out there that really have no clue of using these metrics. It's not a difficult metric. It's really kind of a good starting point. There's many other metrics, and they get more involved. But this one is simply, if I take a trade, where do I put my stop? All right. So right now, it's 6.5. I'll give you that, 6.5. So you can do 6.5, or you can do 7. Or if you really want to do 8, remember that was the 2%er, right? So it all depends. And again, this is for planning purposes, right? It's really for planning purposes. And if you end up taking a trade above the ATR, okay, you end up taking a trade above the ATR, just realize that this is the maximum based upon ATR entry. If you're above the ATR on an entry, right, that's a variance. Okay, that's a variance. You're entering above the ATR. So there's a difference there between your entry to the ATR that's referred to as a variance zone. So you may, if it's a 6.5 point stop and you're up here maybe, a point higher than the ATR, well, maybe your stop is 7.5. If you want to use the max, you don't have to use the max. I'm not telling you need to. What I'm telling you is that is the max, all right, based upon an entry at the ATR. If you get an entry below the ATR, as we talked about there a minute ago, well, you have actually you have positive variance, right? So if you buy above the ATR, in this case, that's negative variance because you're paying higher. If you enter below, that's positive variance. So in fact, your stop on that particular contract, right? Maybe 2.5 points. on that entry. But if you're entering it on the right side of a pivot, that's even better. Why? Because I have a low. I have a pivot low. And that's what we always want to look for. And if that pivot low is above the max and I'm buying on, say, right side of the pivot within that zone, that's giving me positive variance, which means I have a lower potential risk for buying them even below the ATR or selling them above the ATR in the case of a premium. But this gives you a quick visual, all right, of when the markets are moving and we're getting a pullback. And of course, we know we want to buy a pullback, right, somewhere in that zone. You could start up and say, I want to buy, I'll buy one at the ATR. If it goes deeper, maybe I'll buy, number two contract. And then if it pivots back up, maybe then I'll buy number three contract. I just always refer to that as blending. People call it, I don't know if it's really true dollar cost averaging. It's just, I just call it blending, right? I'm trying to blend into a position as efficiently as I can, knowing where my max risk on the position is statistically based upon the research that I've done. Not that difficult of a concept, is it? And that helps keep you, you know, sometimes, again, the also here, the idea is, of course, is you want to enter the first. That's really the metric, by the way, of how I measured it. So every time it's the first touch, this touch here, this touch here, this touch here, those are not measured in those statistics. Just the first. Because why? I want to get the first. And if this thing, if I enter a trade here, and then it flip flops right away, well, that's probably not a good structure I want to trade anyways, and I want to be stopped out. I want to get out. It's not a good structure. Maybe I'm entering into a zonal, you know, trade area. But if we catch a good one, which we're always trying to do, a move outside of a consolidation area, catching that first one, and I know exactly where my max risk is. It just tells you what your max risk that I'm using, the low part of that zone. Then, even here, like in the context of this zone here, again, you can buy anywhere within the zone, even if it's below the ATR, as long as that ATR doesn't shift naturally. But if it does shift, it's an automatic stop out. All right. So hopefully that helps. Thanks, Oris, for the question. I'll show you guys what the parameters are. I'll send a snapshot. You have the latest version. You can update your Sierra if you wish. I think it's 2937 or something, but that doesn't change. Everybody has the latest PTG stuff. All right. So pretty simple concept, but I wanted to kind of create a zone where, of course, before I had a zone above and a zone below, and which was fine, but the zone above didn't really do anything for me. So that's how that came about. Oh, we got some news here. News maybe just popped. Some news just pop out. I don't know. Market just dropped heavily and back up. All right. I don't know what happened there. Something probably. All right, we haven't had a trade since the earlier trade, so I don't know what that one's about, but we'll see. It must have been the $100,000 entrance fee to Truth Social. Trump tweet, blah blah blah. Yeah. Oh, okay. Financial Juice says U.S. has total control over the Straits of Hormuz. I think we'll keep it. All right. So a Trump bomb, Trump tweet. I guess the people that paid $100,000 for that got the early note. All right. That just probably ruined some people's days that were long. So what do I want you to take away from what we just discussed? Here's the takeaway that I'd like you to think about, ponder over. When we talk about taking the first pullback, okay, I want everybody to hopefully this kind of gives you a little bit of um, runway to consider taking it. Now you decide how you want to trade in terms of whether you want to trade a mini or a micro or a portion of micros. You know, maybe you want to trade a half a mini, which is 5 micros. Again, adjusting your risk according to your tolerance. But today I find that we can manage risk so much better today using micros, if that's the case. Again, everybody wants to keep their risk certainly as low as possible. But the key though is really you want to place your stops outside the noise, right? So that 2 to 5 zone right now is very noisy. I mean, you'll get stopped out very quickly. But if you're outside the noise zone as best as you can, then it's okay. It's unlikely, and then people say to me, the question becomes, well, isn't it, I'm looking for the 2 to 1 risk reward ratio. Let me tell you something about 2 to 1, 3 to 1 risk reward ratios. That's a past tense metric. That's a past tense metric. Okay. And don't let anybody bill you out otherwise. A risk reward ratio is from past trades that you can measure that specifically after you've had the trade, because now you get your entry and you got your scale outs. And then you can say, well, where was my stop? And then you do your risk reward. Okay. It's a past tense metric. When you're starting a trade and you don't, oh yeah, I'm always looking for 2 to 1 or 3 to 1 reward risk ratios. I get that. Aren't we all? But how do you know this trade's going to be the 2 to 1, 3 to 1? Yeah, you're going to shoot for those. Without a doubt, you're going to shoot for those. But in the final analysis, after tracked all your trades and say, well, what is my RR, reward risk ratio? What is mine? What's going to based upon your trades and how you've traded it. Right? That's how you have to. So don't let anybody fool you by saying their trades are such and such, right? Yes, we shoot for good R values, but you don't know in advance on the next trade that it's going to be the 2 to 1, 3 to 1, whatever it is. All you do know is what? Where your loss is going to be, where your 1 hour loss, right? I enter here, there's my 1 hour loss, negative 1 hour. I know that for a fact. Okay. The color background on the alert condition, it's just simply the color background just is telling us when it flips, right? That's all. It's just a quick visual when it flips. And the same thing with the color bar. That's all it means. Some people like the colored background. Some people like just a black background, or if you're using a white chart, whatever it is, you don't want a colored background. You don't have to have one. You can configure it without it. Some people like color bars. You don't have to have it. Maybe you like neutral bars, but you like the background color. You can do that as well. There's a lot of configurations, customization you can do stylistically. If you are interested in anything, along those lines, and you want to configure something, customized, just let me know and I'll help you with it directly. Well, if you're going to play the range, you have your upper and lower edges here, right? So you got your I can't read that. Oh, 65s, 65s, right? And basically 80. So that's your range. So again, given that spike and then a pullback and a hold, right? So again, 65s would be on the buy side, in this area. Again, I don't want to place a specific price, but somewhere in that area around 65s if you're going to play the range, right? In terms of if you're looking for an upside break, let it break. I know some people don't; they want to just get in there. But again, just do what you want. But you can let it break and let it kind of hold, right? And then look for that expansion play. If it comes back up and then retreats back in, below, say the value high, then you could possibly play that for a reversion play, right? All depends kind of what you're interested in doing with your plan. All right. So given that little whipsaw with the Truth Social, I still think the long side for the time being, I think it still is viable. Um, but again, still need to kind of clear out 75's, 80 zone to see if there's something can develop a bit more significantly. We're still kind of within the sandbox. All right. So what's the song there, folks? Stuck in the middle with you. Right? Yeah. So 75s, 80s, again, we'll highlight that zone as the way, so let me just note this, right? Bulls need to clear and convert CNC, right? 75, 80 zone in order to get some real traction. Right. And that's kind of where everything stands here at the moment. They're not able to do so. You can see how the volume, again, looking at volume profile, right? You can see how the volume drops off here, even at the edges of the value zone, right? And remember, again, in the middle, right? It's approximately 70%. And then of course we have our 15% up above, right? And 15% down below. So take a look, okay? Even here at the edge of the current value area, it drops right off as prices auction, up near there, right? Volume drops right off. And then vice versa, aside from this spike, okay, okay, the volume pairs off. Right. So I'd like to be, unless there's a breakout, and again, I think the lean still favors longs for the time being. Prices would need to get above here and hold, right? Or down here and hold to change the current rhythms, right? So that's kind of the outline at the moment. If you're looking to take probes to the long side, well, you want to be at the kind of the lower edge here of the range, right? And again, you're just basically looking for a move back up. Same thing if you're up here, right? You're just kind of looking for a move back down. We don't have a huge range, but there's enough to get a piece of it. But again, range trading can, I think it's, of a special skill, all right, to trade a range. And then one thing I do want to note, all right, I was talking to Freddie last night about this. Freddie, are you in the room with us? Or you traveling on the road? When you're in a range, this ATR4, right? So A4 flips, right? A lot in range. Okay. The A4 flips a lot in range. So you want to be careful about that, right? You got to understand the context that we're in. Do I take every A4? No, it's not what we do. We want to try to take the A4 in when the market is finally moving in a more directional way. Okay, when the market is flip flopping, then it's you just kind of say, all right, I recognize it, but just stand aside until the market breaks range. So context is going to always be imperative to identify. If we're just short-term scalping, can we use the slope of the 89 EMA as our understanding of a current lean? So the lean right now, okay, so if we're going to use the 89 as a proxy for lean, what is basically the condition of the 89 is what we're asking, right? So you can see here initially earlier, right? The market pushed down, and so the 89 started, sloping this way, right? So we got this bounce, right? These bounces back up into that area. That is the place to play a short there in this particular case, right? But as you can see here, the slope started just, it's just meandering here. We don't really have much of a slope. I mean, it's not going to be perfectly flat, but you can clearly see that there's barely a slope, on here, right? So that tells us we're clearly range bound. So what is the lean in this particular case if you're using the 89 as your proxy? It's neutral. There's no real directional lean. I mean, that is a lean direction, neutral, but there's no directional influence strong one way or the other. So in this case, we're just going to have to wait for the market to break directionally. What we really want with the EMAs, all right, is we want to see the market, really show us that the market is moving. So like here, right, you can see here that we're getting this shift up. We're getting 13 34.89 shifting. We've cleared out these highs, right, of the previous down move. We've cleared them, and you can see that push. You see the star, right? So that's a 200 star. Now that star is not a short. That star is telling us it's a premium star, right? 200 premium. What is a premium, right? Premium shows us strength. So there's strength on this move. Then we get a little bit of this shallow, somewhat pullback. That move enough. See, here's the thing. That move was strong enough to do what with the EMAs? Remember what the EMA is like? It's kind of like a rubber band, right? It stretches. So in order for the EMAs to stretch, the average price to stretch more directionally, you need to have, in this case, a move up in price first, right? The price has to go first. I'm not trying to predict that the price is going to do that, but when it finally does, right, we can see that the EMAs now begin to what? Diverge, right? As opposed to converge. So they're divergent. And so in the divergence, so this is the 34, right? There's your, 89. So, and this is the price, right? So now we're looking for that price to, kind of come back down into this area. And then we can use these 89, 34, the fair value range as our, now there's a slope, right? There's a slope to it. So now that's good. That's what we want. So the average price now is sloping up. It's giving us that read. So that's where when we get this, first pullback, right? That's where boom, it becomes kind of the best play. So you need to really have most if we're in a range, you need to have that move out of the range, right? And then you get that pullback because then the EMAs will start, you know, moving higher. Then you get that pullback into the EMAs, and that's kind of the idea. You know, it's a good idea. Draw out some of this stuff on your own charts. Like you're playing with crayons in a book and whatnot. You know, just kind of draw it out for yourself. What needs to happen? I always find doing stuff out like on a piece of paper, just outlining something. Do this if you were to maybe you have a niece and nephew or grandson or daughter or anybody for that matter, right? And you wanted to teach them a very simple concept, what would you do? You can explain to them in all the wordy language. They won't understand it, will they? They just simply won't understand it. They don't know the concepts. But if you draw it out, yeah, you draw pictures to teach them. There you go, Ernst, right? You draw pictures to teach them. Well, guess what? Draw it out for yourself. And guess what's going to happen? You're the teacher and you're the student. Draw it out. You will retain it because our minds really, kind of think in images. Even when you think about a word, the word the word that is spelled out, the word you're saying is actually spelled out. So you're actually seeing the word. So it's a picture. Draw it out. And all of a sudden you say, oh yeah, this is what I need to see. Well, when you see it in price action, that's what I need to see. It could be fun too. Draw it out. That's what that's why I have this little pen and I like to draw to show to demonstrate that. What are we looking for? How are those slopes happening? How's that EMA shifting? What's causing the EMAs to do what they're doing? You know, so the price is always going to be the fastest, and so we use that. Well, I think this is more of a teaching session than a trading session. My goodness. How about anybody over there in the pit? You guys are all set? Any questions over in the pit room? Be sure to take advantage of the eval this month, today through the 31st. Give it a shot. Mm. 11.5. All right, guys, I have no position on at the moment, and you probably know why. Because we're in this, you know, chop chop area. There's no real momentum. There's no. It's just, yeah, it's low probability. Just low probability. You gotta know when to stand aside. You know, and we've kind of flip flopped here between the long lean, short lean. I mean, in neutral, using the 89, but I'm just saying kind of the lean on. We need a break outside of this zone, and it's probably will, but we need to, like yesterday, we need to get a break and a sustained move. So again, we need to break that 60-65 area, right? Again, with a sustained, move. What's happening is that people are trying to, you know, jump on it and try to anticipate, and then they get scrubbed, and then it goes right back in their face. Let me show you guys. I'm going to take no, wait a minute. Let's see. See. Oh, my. So what you want to do on the ATR, you want to put that zone the way I have it. You go into the DV strategy. Okay, go into the DV strategy, go into the settings, and it's the threshold, right? The ATR threshold. So let me just all right. So you want to make sure that the ATR threshold is 26, 6.5 points, 6 there, and 0 there. Okay. So there's the settings for that. If you want to match them up to what I have with the idea of the maximum adverse excursion, max risk zone. Okay. Um, there it is. Just configure it the same way on the ATR1, which is the AF4, 26 and 0. So that's 26 is basically 6.5 point stop, maximum risk on that. So there's your setting. Match that up. Again, that is on the DV strategy. So on this one, I think this one's 28. Yeah. So this one on the A3, just make it 28.0. So 7 points. Now, if you configure it the way I showed it on there, it'll just do it on the ATR. If you're running a DV strategy zone A10, it's going to post it on that. So when you're doing, like, if you're doing a if you're running both the A4 and the A10, so as a dependency, okay, so you're running an A4 only if it's aligned with the A10. Yeah, okay. You can just still just configure. So obviously you have the A4 and the A10 on the same chart then, right? So then just come okay, so then just simply combine them. So do the 26.0 on the A4 setting, which should be ATR1, and ATR3 should be the 28.0. Yeah, you can yeah, so on this one, right. So on this one, if I wanted to show the A4, okay, if I wanted to show the A4, okay, so here, in the A4, so we would go here. All right, where's the uh, oh, here we go. So on the if you're going to do that, you're going to go 26.0, okay, and then what you'll do, okay, is A1 requires alignment with the A3, okay. So then you're going to also turn on the A4. It should do it. See. Let's see. Hold on a sec. Uh, hold on. Oh yeah. Okay. All right. I see why. All right. So what will happen is this. So let me just show the status window. Okay. All right. I know why. So right now it's on set to A10. Okay. And if I wanted to set it to A4, there you go. All right. So A4 and real. That's how you have it set up for us. So when you do that, you'll see the zones. Yeah. So it's when you switch. See, I had it still set to A10. That's why I didn't see them. All right. So when you switch it to A4 first and then real, then now you see the A4 zone 26 that we have it configured as. Okay. Just like down over here separately, you'll see it on that now. So that's the way that will display. And if you go back to A10, it's just going to show the zone against the A10. Yeah. So that's how you do it. And this one, I'm just leaving it at A10, so I'm not using the dependency. Yeah, hopefully it helps. Give you some perspective. My sense is it'll really help when we have these days where markets are moving around nicely, and the idea is to perhaps give a level of confidence. Now, it looks like a wide zone, but if you kind of use it from the standpoint of, well, that's where my max risk will be at that entry point, then you can adjust your positioning accordingly. Basically, 300 or so dollars per contract. That's not bad. I mean, in the world of ES trading, that's not bad. If you want it smaller, you do micros. But here's the thing with my philosophy. You shouldn't, yes, we want to reduce our risk as much as possible, but you really don't want to, be obsessed with, well, maybe you do want to be obsessed with managing your risk, of course, but you don't want to be obsessed to the point where, you're trading scared money, right? If you can't handle a, 6-point loss or 7-point loss, $350 or whatever, per contract. Okay, trade the micros. I'm waiting for the day where they do a hybrid, micro mini, where they offer you the risk of a micro with the profit potential of a mini. Right? That would be great, wouldn't it? I don't think they'll ever develop that, but that's what I'm waiting for. Risk of a micro, profits of a mini. Exactly. Heads I win, tails you lose. In my dreams. All right, we have an 8-4 short here. Did we get triggered off of that? Yeah, we got triggered off of a premium. Let's see if they want to do it this time. I will be cutting out here at 11:30 in about, I guess, 10 minutes or so for the day for my slot this morning. Danny with an I is coming on at noon in her apportioned time. So stick around. Yeah, I'm conversing with some other people outside the community here that I talk to, and literally nobody is doing much of anything today. So if you feel as though that, you should be doing something here in the markets, you may want to address that to yourself. Why do I feel as though I must be doing something if there's not much to do, if the market's not offering us a good opportunities? That's where it's all this mental game we've been talking about, right? By the way, if anybody would like to at some point, going forward, ever want to take the mic, I believe the mic is available now for everyone. If you have a headset and you want to jump on, I'll verify that with Marlon, but I'm pretty sure it is available. Just want to make sure that the integrity of it works properly. Mm. All right, short A4 here, short premium. Let's see if this will be our last trade for my segment. All right, two scales out on the A4 short. Stops at place right above the pivot high. Cost of the position here is 77. Actually, theoretical average now is 71, 77, 71. So what that blue line represents is the break even, okay, on the entire position. So if the balance of the position, if price jams up there and gets stopped out, it's a scratch, right? So that's the cost of the position. I have the stop below that. So that means we'll, on this position, if price were to move back higher, all right, we're going to walk away in the green on this, but that's the cost of the position. So as price moves lower and take profits, all right, that blue line moves, in this case, moves higher away, moves higher. So the core cost of the position actually goes higher. Break even, that is, not cost, but break even. All right. So it's kind of a good metric to see where's my break even. Everybody, when you take trades, do you know automatically where your break even is? in your head. Some of you do. You know, the mathematical wizards do, but I would say most don't really. You'd have to calculate it. What this does, it automatically shows it to you. That blue line. No need to calculate. No need to guess. All these hidden gems, by the way, that we have within the PTG Trader Toolbox. There's so many hidden gems that are designed to reduce the amount of work that you have to do. So you can focus on the decision process of your trades. All right, any final questions for anybody? The last 3 minutes? Giddy up. Give me some questions. Everybody's good? Please be sure to consider the evaluation, the 40% off the evaluations over there in Pitbull. Again, that helps us keep the lights on here with you guys, trying to give you quality content, different viewpoints that you can implement in your own trading. And of course, if anybody wants to reach out to me and would like to discuss their own trading, obviously I'm available throughout the week. So just send me a private message and we can set up a time to connect. Okay, Renee, I'll be heading out here in 2 minutes here at 11:30. We'll be shutting the stream off. Renee is our resident production and specialist for the Pitbull Traders Media Group. So we want to thank Renee for his persistent help and expertise in helping produce what you guys see. So thank you, Renee. Renee, take a bow. Come on line, take a bow. Say hello to everyone. All right, guys, that's going to be it then for me. Thank you again for your attention, questions, and again, hopefully you got something out of this. We always try to get something at minimum educational, at maximum some profits, and hopefully we reduce the amount of negative trades where we can and maximize the profits where we can. All right, so stick around for Danny with an I. She'll be coming on at noon, and she'll be a host taking you through the minded markets. Have a great rest of your day. Again, I will be around. I have a few meetings this afternoon. And trade well. Talk to you soon.
Hello. Does this make a difference? Hello. Let me get this up.